Gurmeet Chadda joins us now, managing partner and fund manager with Complete Circle Consultants. Hello, Ji, long time.
All good, Nikunj. Good morning. Good to connect.
How are markets looking? Not going here, not going there.
In a way, Nikunj, it's not bad, considering that what all has happened, right? In terms of we have our own war
जब टीवी पे आता है जैसे
with Pakistan, we've had geopolitical issues, we have had heavy FI selling for the first 4 months of the year. Even if you see now, the net position is 73-74% short. You analyze this better than most people. So I think considering what all has happened, I think the market YTD is up 5-6% for the year. It's pretty flattish. While we have underperformed markets like, for example, Korea, Brazil, China, which are up 15, 20, 25%. I think this tariff uncertainty, once it goes, the other part of the index, which is, let's say auto, bit of IT, bit of export-oriented themes, uh, partly commodities, would probably start catching up as we get more clarity and market prices that in. Also, Nicole, the earning growth, on a best case scenario this year would be like 11-12%. Now, once you are at 11-12% earning growth, the market is trading 20 times. I think what you're seeing is good. I think some time correction may not be bad news. And I think the investors also have been telling this in various forums that you now need to reset the expectations. You cannot have 20-25% kind of returns. The last 3-4 years have been very good. Last 6-8 months has been very sobering. And I think if you reset the portfolio with in line with earnings growth, which is 10-12%, I think there are better opportunities. So the starting point is important. And if your starting point is again targeting 20%, you're bound to make more mistakes.
Absolutely, but I think Gurmeet, hi, morning firstly. The question really is whether there are any exits and adjustments to be made to your portfolio.
Yeah, so what we are doing now is trying to get overweight on the entire rate transmission story. So, for example, while banks and financial may have a slightly softer quarter, especially private banks, but they will still contribute to 32-34% of the profit pool of Nifty. And as rates come down, as you will see home loan rates at 6.5, 7, car loans at 6.5, 7. I think people have forgotten what happens when rates do fall and transmission happens. You see a revival in the consumption side as well. So we are getting a little overweight on banking and consumption names, especially, and both are slightly underowned because of the relative underperformance. Banking obviously has recovered in last couple of months. We are trying to get to some chemicals also where the end use is again consumption. Again, very underowned. The earnings might now relatively start surprising with a very low base. Destocking has happened to a large extent. We are selectively looking at chemical names, especially on the zinc side, on phenol side, on fluorine side. And we are trying to get into some, more defense names in line of what has, there's been an emergency purchase and the defense secretary is talking of 2 lakh crores worth more of defense orders. And this largely pertains to surface to air missile and air defense system. I think these are the two biggest beneficiaries of that. So we are getting overweight there and seeing if there are any low hanging fruits and tactical opportunities. The portfolio is more defensive than what it was some time back, and that has to reflect the changing reality and valuations.
Right, Gurmeet, hi, morning. If you talk about India's performance compared to other major economies, we've underperformed markets like China, South Korea. Now that we have a little bit of clarity on the tariff front for China and South Korea, we still are awaiting to hear from US on the trade deal with India. Do you believe if the trade deal is slightly more favorable for us, do you believe that now could be a time that India could outperform other emerging markets?
We can relatively, but as I said, you need to see a broader earning recovery, maybe 15-18%. That doesn't look uh, uh, at least true for next 1 or 2 quarters. See, your nominal GDP growth this year would be more like 9-10. With inflation, last print was 2.8 on the retail CPI and WPI has been pretty flat. So, and your GDP growth, let's say best case is 6.5, 7, even if you're optimistic, which means the nominal GDP growth is less than 10, which means the earning growth also will be in line, maybe 1 or 2% more in the broader market. So at 12% earning growth, the expectations has to be set, and we may outperform. It may happen that India recovers with more clarity coming on tariff. Number one. Number two, I think that there are other opportunities which can give you double-digit return, and that's the reason you have to focus on risk-adjusted returns. So look at, for example, the spread between today 10-year bond and the 30-year bond. It's about 50 basis points. It's never like that. It's almost like 10, 20 basis points. So if rate transmission happens, the yield can drop 50, 70 basis points overall and some 20, 30 bips on compression, which means you can have a 60 to 80 bips kind of yields falling and compressing, which can lead to mark-to-market gains of 5 to 6% on the long bonds. And with a coupon of 6.5, you can actually make 12% in a bond, long duration bond, with obviously some volatility. I think the way dollar index is behaving, there is more. I think I'm very particularly constructive on commodities, especially gold, silver, and copper, etc. And then you have equities which can deliver identical earnings and similar returns. So if you have more balance in your approach, you can make that 12, 13, 14% with lot lesser risk. And that is what is important right now, rather than betting on the events. Yes, of course, if the event happens, tariff clarity comes, we can have a better H2 compared to H1. I'm not ruling that out. But that would be more lumpy, and I don't know how much it is sustainable. So if you get to 24, 25 earning multiple, market goes up 10, 15%, then again you have a similar problem coming a couple of quarters down the line.
The headlines in the month of March. Tax cut will kick in, consumption will come back. Let liquidity come back, credit growth will pick up. Let interest rates go down, car sales and motorcycle sales will pick up. Everything has happened and credit growth is down, consumption is down, monsoons have come and nobody is buying cars and autos. So whatever we are assuming, even though we are getting more than what we anticipated, it is not translating into earnings, demand, or for that matter, anything which indicates that the economy is coming back.
Because partially true, but if you look at, for example, rural sales, I think there is already early signs. Look at two-wheeler numbers, especially for TVS. Auto, if you look at tractor numbers and LCV numbers, the tractor numbers and farm equipment numbers are picking up. So there are early signs. There are a little bit of green shoots there. Look at private capex for last year, for example. It did 13 lakh crores. For I think after 2013, first time the private capex was more than the government capex, right? So that's something we got to be noticing and careful, in terms of our portfolio assessment. So my sense is yes, there are early green signs, and a lot of it probably market is also trying to price in. So even the automobile stocks, for example, M&M isn't really cheap. You're still getting it at 26, 27 times, right? So a lot of good news, assuming good news comes through, and I'm supporting your point, is some of it in the price. And where the numbers aren't very good, even there, it's not that you're getting stocks at 5, 6 earning multiple. Let's say, for example, IT, where you'll have probably more flattish quarter. It's not that you're getting HCL Infosys at 13, 15 times, right? So that's why I'm saying it's important to reset the expectations. I think if it's around 12%, you'll be better off. As I said, the opportunities will come with if you deep dive into value chains. You have to get into things like power equipments, where probably there is huge transmission capex happening. You have to get into some new stories on semiconductors. You have to get into some more themes like recycling, because that's something which is really starting in India, and something where government is very keen on spending. So one learning for me last 2, 3 years has been be very focused on where government is spending more. So they spend more on electronics. We saw what happened with Dixon or Keynes or Amber. They were very clear on defense in terms of import substitution, more purchasing. We've seen a huge upside in defense names. So it's very important we see where government is spending money. And I think now the focus is coming back to driving up consumption. So that's where the portfolio has to be positioned.
What is the best way to bet on consumption? Buy HUL, Nestle, Colgate, or buy the new niche consumption categories, BPC, or anything which has got to do with hospitality, religious tourism, spiritual tourism? What is the new category now?
So I think it has to be a little overweight discretionary, where the Gen Z is spending more, and I think that makes up the bulk of the consumption. So I think we are extremely constructive on hotels. We have been very lucky with Indian Hotels and Lemon Tree. We were very early there. But Interglobe is another. I think despite persistent promoter selling, and by both promoters, one obviously the Gangwal Group has sold more. We've seen that despite too much supply, Indigo has really done well. And I think what has happened, unfortunately, it will probably continue to gain more market share. And there are issues in terms of supply on Boeing models. So and Indigo is largely Airbus. So that also in near term will add more to the operating metrics. We have to look at some more digital consumption themes. We have Eternal in our portfolio. We are looking at PB Fintech as well. And then maybe tactically look at some of the FMCG names if some volume growth comes back. For example, HUL return 5 years is flat. Nestle 3 years is flat. ITC largely weighed down by again bad group selling. Gives you is available at 14, 15 times. So maybe in consumption you can have be 70% in travel, hospitality, discretionary names, and maybe 20, 30% in very under-owned names in staples, because one quarter you get 2, 3, 4% volume growth more. And I think rural recovery is giving me a sign. Look at Marico, for example, very good update last quarter. The food and the hair oil segment in particular is doing better within staples. So selectively, maybe 20, 30% there and about 70, 75% in discretionary.
Okay. HDFC Bank at 2000. अरे smile करो. You've been tweeting a lot about HDFC Bank not going up. Or smile
Forever
करो.
fan.
Which is the next big one?
No, I'm delighted with that 20,000 and probably should do more because I'm an investor since 2007. But I think purely on operating metrics, POP numbers, I think ICICI has been a little more subdued, which is actually a little surprising to me again compared to SGFC and Kotak. Obviously, SGFC and Kotak didn't do much for almost 3 years. So I think ICICI Bank will again have an industry-leading performance, both in terms of CASA, deposits, as well as the advances. And then what I like is the way they have positioned their lending portfolio, the high yielding part of the portfolio, which is loan against, used cars, LAP, other products. So they have a right mix of secured, unsecured, with yields also moving up. Also, if you see, Nikunj, they have done a beautiful thing in last 3 years. There are no product-wise targets. So there are no insurance targets, no cards targets. A branch has to achieve unit profitability. And amongst all private banks, ICICI now has the lowest attrition. HDFC Kotak are struggling with 25, 30, 35% attrition at the branch level. And I think culture is very important because I come from that background. Once the culture is right, bank then continues to deliver outstanding returns for a long period of time. And at some point of time, I think banks need to introspect the focus they have on insurance and fee-based products versus core banking. And I think ICICI is getting that balance right. I also think SBI could unlock some value with more listings coming up. For example, look at HDFC MC, it's over 1 lakh crore, on about 8 lakh crore AUM. Now, SBI MF, once it comes, gets listed, it's at 12 lakh crore. And the yields are identical. It's about 40 basis points, which means it could do like 3,000 crore kind of a PAT. So that could lead to some value unlocking. SBI General, SBI Capital Markets. I think if you add subsidiaries, give a little bit discount, I think even then that probably could add 20, 30% to SBI. Secondly, I think even in valuations, I think despite posting very good numbers, SBI still doesn't get the rating multiple some of the private banks get. I'm not saying it should get a 3 price to book, but the way it has turned around, I think it should deserve a slightly better multiple than what it is right now, which is around 1.3 to 1.5 times. So I think that looks pretty good to me. So I would prefer them. And then I like Federal because for the leadership change that has happened there with Mr. Manian coming, who was very, very, was a key pillar behind Kotak's success in last 2 decades. The only issue with Federal Bank is, again, as I said, culture. It is still a South-based bank trying to diversify. Again, if he's able to build and bring around that change there, I think Federal could again be one of the another bank, mid-sized banks to look at.